Okay, let's take up the multiple choice problems, beginning with questions 1 and 2. Here, BT Incorporated acquires 100% of the voting stock of Gatax Company on January 1, 2024 for 500,000 cash. The contingent payment of 12,000 will be paid on April 1, 2025 if Galaox generates cash flows from operations of 26,500 or more in the next year. BT estimates that there's a 30% probability that Line will generate at least 26,500. Line is Tuliga Talks and uses an interest rate of 4% to incorporate the time value of money. The fair value of 12,000 at 4% using a probability weighted approach is 3.461. Question number 1. Under PFRS 3, what will BT record as the acquisition price on January 1, 2024? So we have now 500 plus 3,461. Now that's the fair value of the contingent payment of 12,000. And we have 3,461 given. So we have letter B for the answer. Assuming that the Ox generates cash flow from operations of 27,200 in 2024, actually the condition is for Gataox to generate cash flow of 26,400. This time, it was able to generate 27,200. How will BT record the 12,000 payment of cash on April 1, 20x5 on April 1, 20x5 according to PFRS 3. Okay, so we have now the payment of cash on April 1, 20x5. Now that's contingent payment that will be paid on April 1, 20x5 if the Taox generates cash flows of 26,400 of 500. Now this time, the Taox generates 27,200. So what will be the answer? B. Debit contingent performance obligation by 3,461. Debit loss from contingent performance obligation and credit cash of 12,000. Actually, the contingent payment is 12,000. So we have now letter B. Next, numbers 3 and 4. On January 1, 2024, RR Corporation acquired 80% of SS 10 par common stock for 956,000. On this date, the fair value of the non-controlling interest was 239,000 and the carrying amount of SS net assets was 1 million. The fair value of SS identifiable assets and liabilities were the same as their carrying amounts except for plant assets net with a remaining life of 20 years, which were 100,000 in excess of the carrying amount. For the year ended December 31, 2024, SS had net income of 190,000 and paid cash dividends totaling 125,000. Number 3, in the January 1, 2024 consolidated balance sheet, the amount of goodwill reported should be. So in number 3, we have now 95,000. So that's letter C. And 95,000 is computed as we divide 956,000, that is the investment of RR for an 80% interest. So we have now 956,000 divided by 80%. So that will involve only an 80% investment. So we have 1,195,000. And we deduct 1 million for the carrying amount of net assets was 1 million, and we also deduct the 100,000. This is now the which were 100,000 in excess of the carrying amount. So we have now 1,195,000. We deduct 1,100,000, so that leaves C. That's in the consolidated balance sheet. The amount of goodwill to be reported is 95,000. 4. In the December 31, 2024 consolidated balance sheet, the amount of non-controlling interest reported should be. So that's now letter C for 251,000. We now multiply the 20% interest, non-controlling interest, and we multiply it by 956,000, and adding the investment of a non-controlling interest of 239,000. Now 20% of that, and then we add 190,000, the net income of SS, and we deduct 5,000, and also we deduct the amount of 125,000. Now take note that we are deducting two amounts, 125,000. That's now the cash dividends totaling 125,000. And we have now the 100,000 divided by 20 years. So the amount of 5,000 per year. Now that's the amortization of the allocated excess. So we have now 20% of 956,000, 956,000 added to 239,000. So that gives 1,195,000, and then we have the amount 1,195,000, and we multiply this by 20%. So that gives 239,000, no, for that purpose. And we have 190 minus 5 and minus 125. So all in all, we are deducting from 190 the total of 130. So leaving only 60,000. So finally, we have 251,000. Now the question is the amount of non-controlling interest should be, and again, we are adding 956,000 and 239. thousand. Okay, to 906,000 added to 239. So that makes 1,195,000. And then we add 160,000 to 1,195,000. So we get the result of 1,355, and then multiply it by the amount of, or by the rate of 20%. So we now get the amount of 251,000. Now take note that number 4, the answer is letter C, 251,000. Next, we go to question number, I am just selecting the questions, meaning I am not going to answer all, but anyway, if you want, I am going to share screen the answers to the questions 5A, and then we have 6C there, that's 6 and 7. Use the following information for question 6 and 7. January 2, 2024, PP Company acquired 75% of KK Company's outstanding common stock. Selected balance sheet data December 31, 2024 are as follows. So we have now PP and KK with total assets, liabilities, common stock, and retained earnings. In number 6, in PP's December 31, 2024 consolidated balance sheet, what amount should be reported as a non-controlling interest in net assets? Now, here we have the non-controlling interest of using full goodwill at the end of 20x4. We have now the book value of the stockholders' equity in the amount of 1 million. We have the book value of stockholders' equity by December 31, 20x4. Now, we have the total of 1 million, and then we add the net income of 150,000. So adding the net income of 150,000, we now get the total and deduct the dividends in the amount of 90,000. We have the total of 1,060,000. Then we have to reflect adjustments in the total assets. Now we have adjustments, and we have now the amortization of the allocated excess, and we have the fair value of the stockholders equity, and then we multiply it by 30%, no? Take note that in number 6, actually the question answering number 6 here actually is not the answer, because by the way, we have two number 6 on page 327. We have one number 6, and on page 328 we have another number 6. So I'm now beginning with the first number 6. Okay, so repeat number 6. January 1, 2024, Pine Company purchased 70% of Shine Corporation's 10 peso par value common stock for 900,000. On this date, the carrying amount of net assets of Shines was 1 million. The fair values of identifiable assets and liabilities were the same as their carrying amounts except for plant assets, which were 200,000 in excess of the carrying amount. For the year ended December 31, 2024, Shine had net income equal to 150,000 and paid cash dividends totaling 90,000. Excess attributable to plant assets is amortized over 10 years. In the December 31, 2024 consolidated balance sheet, the non-controlling interest should be. So now that's the first number 6 with the answer here in the first number 6. So we have first we involve the book value of the shareholders equity of the acquired company equal to 1 million. Then we add the net income for 150,000, the total 1,150,000. We deduct the dividends, so that leaves shareholders equity for December 31. So we have now year 2 for total of 1,060,000. And then we have the adjustments to reflect fair value under valuation of assets and liabilities as of the date of acquisition. And it's the amount of 200,000. So we are now treating 200,000 being an over or no, an undervaluation of the plant and we have here plant assets. So we have 1,260,000 and we deduct the amortization of the undervaluation in the plant assets for 200,000 and we divide it over a period of 10 years. So that leaves 1,240,000 and 1,240,000. We have now the 30% non-controlling interest percentage because we have 100% minus 70% parent. So we have now 372,000. That's the non-controlling interest partial. Then we are adding the non-controlling interest on full goodwill of 85,714 and we deduct 60,000. We deduct 60,000. Now that's the non-controlling interest on full goodwill. So we get 25,714. The non-controlling interest full is letter C. That's in number 6, 397,714. Now, if we have 900,000 as the given amount of the purchase price, so 900,000 divided by 70%, that's the interest acquired. So the 100% is 1,285,714. Then we deduct the 1 million being the carrying amount or the book value of the uh, subsidiaries net assets. Given is 1 million, we have 285,714 as the excess. Then we deduct 200,000 the given undervaluation of net assets. So we have now 85,714 being the full goodwill. Now, on the other hand, if we use the partial goodwill approach, the 900,000, then we deduct 70,000. That's the fraction of the interest acquired. So we now get 700,000 deducted from 900,000. You have the difference of 200,000. Then we deduct 200,000, the excess multiplied by 70 percent, 200,000 multiplied by 70%, that gives us 140,000. So from 200,000, we deduct 140,000. Now we have the partial goodwill approach in the amount of 60,000, or you have 200,000 minus 140,000, or you merely multiply 200,000 by 30%. That will give you the partial goodwill. It is assumed that full goodwill is used, but it should be noted that PFRS 3 uses either the partial or the full goodwill approach. They are still considered as acceptable. So, meaning our answer to the first number 6 is here 397,714, and that's now letter C. Then we have this second number 6 with two questions 6 and 7. In PP's December 31, 2024 consolidated balance sheet, what amount should be recorded as non-controlling interest in net assets? So what amount should be reported as non-controlling interest in net assets? So number 6, we have now the amount of 50,000, and then we add 70,000 and multiplied by 25%. Now we are having 50,000 as the common stock of KK and the retained earnings of 70,000. The total stockholders' equity of KK upon acquisition was 120,000. Then we multiplied this by the non-controlling interest of 25%. Then it gives us 30,000 for letter D. Then number 7, in its consolidated balance sheet at December 31, 20x4, what amount should PP report as common stock outstanding? So actually, it's the common stock only of the parent because we have to eliminate the common stock and the retained earnings of the subsidiary. Now we have the answer to number 7 as letter B. Next, we will take up 12 to 16. However, I can share screen with you numbers 8, 9, 10, 11. Okay, so up to number 11. Then we take up next numbers 12 to 16. Watkins Incorporated acquires all of the outstanding stock of Glen Corporation on January 1, 2004. On that date, Glen owns 3 assets and has no liabilities. So given are the book values and as well as the fair values of Glenn's assets. So we have now the inventory and the equipment, building, and given are the estimated lives. So we are also given the fair values of the three assets. If Watkins pays 450,000 in cash for Glenn, what amount should be represented as the subsidiaries building in a consolidation at December 31, 2086? So that's 2 years, no, 3 years after acquisition, assuming the book value at that date is still 200,000. So we now refer to the building with on January 1, 2004, the book value is 200,000, the fair value is 300,000. So we now go to number 12. The book value of the building by January 1, 2004 was 200,000. Then the adjustments to reflect fair value, 300,000 is the fair value and the book value is 200,000. So meaning there is an undervaluation in the amount of 100,000, which we have to add. Then the depreciation for 3 years equals 100,000 divided by 20. So we are now computing the added depreciation based on the fair value. So we have the increase in the fair value of 100,000 as compared to the book value is 100,000 and divide by the remaining life of 20 years. So that gives 5,000 a year. For 3 years, it's 15,000. So number 12, we are asked for the what amount should be represented as the subsidiaries building in a consolidation on December 31, 2006. Now we have letter B as 285,000. In number 13, the answer, if Watkins pays 400,000 in cash for Glenn, what amount would be represented as the subsidiaries building in a consolidation, assuming the book value at that date is still 200,000. Now the answer is still letter D, the fact that the acquisition price does not affect whatever amount of depreciation to be recorded, but you only have to involve the estimated number of remaining life and comparing the book value with the fair value. Okay, number 14. If Watkins pays 450,000 in cash for Glenn, what amount would be represented as subsidiaries equipment in a consolidation on December 31, 2086, assuming the book value at that date is still 80,000, and that is the same book value on January 1, 20x4. So in number 14, number 14, we are now dealing with the equipment. The book value in January 1, 20x4 is still 80,000. Then we have the adjustment to reflect fair value, 80,000 minus 75,000. So there's an adjustment of 5,000. Then the depreciation for 3 years is taken by dividing 5,000 by 10, assuming that the remaining life of the equipment as given is 10 years. So that will be 500 a year times 3. 1,500. So the adjustments, now take note that this is the reverse, or its treatment is the reverse of the treatment of the building. The fact that building has an undervaluation. The book value is only 200, the fair value is 300. However, in the case of the equipment, this involves an overvaluation. So the treatment in number 14, the book value of equipment 80,000, and then we have the overvaluation, deduct 5,000, and the depreciation should be added. The fact that we have an overvaluation by 5,000, where we have to add back the depreciation expense to the amount of the book value of the equipment. So we now have 76,500 in number 14. In number 15, the question is, if Watkins pays 450,000 in cash for Glenn, what allocation should be assigned to the subsidiary's equipment in preparing for consolidation at December 31, 2026, assuming the book value is still 80,000. So in number 15, we have adjustments to reflect fair value of 5,000, and then we have the depreciation of 1,500. So we have now the difference of 3,500. What allocation should be made, assuming that the book value is still 80,000. So the answer is letter A, 3,500. Then last, number 16, if Watkins pays 300,000 in cash for Glenn, at what amount should the subsidiary's building be represented in the January 2, 20x4 consolidation? So we now have the book value of number 16, book value of building. Please make correction. 16, that's building. Book value of the building, January 1, 2024, 200,000. And then we have the adjustments to reflect fair value in the amount of 100,000. So 300,000 is the amount that should be used for the subsidiaries building on January 2, 20x4, which is the date of acquisition. Next numbers, we have 17 up to 28. Please make correction in the numbers. Make correction in the numbers, that's 17 to 28. McGeary Company acquired 90% of Hogan Company on January 1, 2024 for 234,000 cash. Hogan's stockholders' equity consisted of common stock of 160,000 and retained earnings of 80,000. Analysis of Hogan's net assets revealed the following. So we have now an analysis of Hogan's net assets reveal the following. We have now the building with 10-year life, equipment with 4-year life. Then we have land, a book value of 5,000, fair value of 12,000. Now, any excess consideration transferred over fair value is attributable to an unamortized patent with a useful life of 5 years. In consolidation at January 1, 2024, what adjustment is necessary for Hogan's building? So we have now the building with book value of 10,000. The fair value is only 8,000. So we have now the decrease in the building account. In other words, the building's book values and fair values, there is an overvaluation. So we now have decrease in building account, fair value 8,000, book value of 2,000. No, we have the book value of 10,000. So the difference is an overvaluation by 2,000. So that gives us number 17, letter B. Okay, being a decrease in the building account representing overvaluation. Next, number 18, in consolidation on December 31, 2024, what adjustment is necessary for Hogan's building account? So in number 18, we have the decrease in the building account in the amount of 2,000. So we have now uh, here 2,000 and decrease, and we have the increase due to depreciation. Take note that the decrease in the building is with a book value of 10,000, the fair value is only 8,000, so there's a decrease. But we have now 200 to be deducted. Actually, there's an increase due to depreciation. We have now the amount of 200 to be offset from the decrease in the building account. So for 200, decrease in the building account for 1,800. That's letter D, 1,800. Next, in number 19, in consolidation, December 31, 2025, what adjustment is necessary for Hogan's building account? So in number 19, decrease in building by 1,800, and we have another increase. Take note that this is already the second year. So we have now the amount of 200 to be deducted. So we have the decrease in the building account now to only 1,600. Then in number 20, uh, the question is in consolidation on January 1, 2024, what adjustment is necessary for Hogan's equipment account? Now take note that the equipment, the book value is only 14,000. The fair value is 18,000. So that in number 20, we have now the increase in equipment account from uh, the original book value as given in the equipment account, the book value of 14,000 and the fair value equal to 18,000. Actually, the solution is the reverse of what is given in the problem. In the problem, the book value is 14,000 and the fair value is 18,000. So it's the reverse of what happened in number or for building. For building, there is a decrease comparing the book value with the fair value. So that in number 17, in the building account, it's the fair value is only 8,000 and the book value is 10,000. So there is a decrease in the building account in the amount of 2,000, considering that the fair value is lower than the book value. And the increase here due to depreciation. Actually, we are decreasing 2,000 by 200. So the building account this time will only be left at 1,800. Now, the deduction is due to, or 200 is due to the amortization of the decrease in the amount of 200. Whereas in the case of equipment, it's the reverse. The book value is 14,000 and the fair value is 18,000. So the difference of 4,000 is actually an increase. So will you now correct the data or the solution? The fair value is 18,000. The book value is 14,000. Following the given figures in the book. So the increase is 4,000. The increase in equipment in number 20, not number 76. In number 20, for the amount of 4,000, then we have now the decrease due to depreciation. We have the amount of 4,000 increase divided by 4. So that gives us the difference of 1,000. The remaining life of the equipment is only 4 years. So we have now an increase in the equipment account. That's the decrease due to depreciation. It's the reverse. So we have now in the next case, in number 23. In number 23, in consolidation, what amount is necessary for the land account? What amount is necessary for the land account? So the land account here, the book value is 5,000, the fair value is 12,000. So in other words, there is an increase in land account. Fair value 12,000, book value is only 5,000. There's an increase in the amount of 7,000. Next, in number 24, in consolidation, what adjustment is necessary for Hogan's land account? So in number 24, you refer to number 23. There is no depreciation or amortization. This is land and we do not depreciate or so anyway, number 24 is letter B, when there is an increase, no? The question in number 23, in consolidation, what adjustment is necessary for Hogan's land account? So in number 23, that's number 7, an increase. In consolidation, what adjustment is necessary? Again, there is an increase in the amount of 7,000. In number 25, what adjustment is for December 31, 20x5? What adjustment is necessary for Hogan's land account? That's the next year. So number 25 is still letter B. Then in number 26, in consolidation, what adjustment is necessary for Hogan's patent account. Now, for patent, it's stated the problem that here for number 17 up to 28, any excess consideration transferred over fair value is attributable to an unamortized patent with a useful life of 5 years. So any excess or consideration, that's now in number 26. The increase in the patent account is 11,000, and we have now the book value of zeros, so we have the increase in a patent account of 11,000. 234,000, that's the investment of the parent for a 90% interest. So we deduct 160,000 for and retained earnings of 80,000. So that gives us 240,000. So we now get the difference of 20,000. So again, dividing 234 by 90% is 260,000 minus 240,000. It gives us 20,000. And then we deduct 4,000 here, 4,000 for the equipment's under valuation. Okay, for the equipment under valuation, and we have 2,000 for the overvaluation of the building, and 7,000 for the undervaluation of land. So we are now deducting the amount of uh, 4,000 plus 7,000 is 11,000 minus 2,000. So that gives 9,000 as the net amount deducted from 20,000. So it leaves 11,000. That's now the fair value of the patent account. So in number 26, the answer is letter E. Then number 27, the increase in patent account. We have now number 26, and we deduct the decrease due to amortization. 11,000, as the given estimated life of the patent is 5 years. So we have 11,000 divided by 5. This is the amortization of patent. So 11,000 minus the amortization for year 1 of 2,200, leaving us the increase in patent accounts in number 27 in the amount of 8,800. That's letter E. And number 28, in consolidation, what net adjustment is necessary for Hogan's patent account on December 31, 20x5? So in number 28, we now have the increase in patent account in number 27 above, not number 160, 27. 8,800, and the decrease due to amortization. Now, please make correction. When we talk about intangibles, we call the decrease as amortization. When we talk about tangible fixed assets, then we call it depreciation. So we have now decrease due to amortization. So in number 28, the net adjustment to the patent account is 6,600. Next, number 29. 29, the question is, applying the cost model or method would give a debit balance in the investment in stock of Southwestern Company account at the end of 20x5. So we have now in number 29. Our answer is letter D, the equivalent to consideration transferred in the amount of 320,000. Applying the cost model method would give a debit balance in the investment in stock at the end of 20x5. So that would mean the original investment of 320,000 remains as we are using the cost model. As we have to understand that under the cost model, the balance of the investment account remains at cost, whereas under the equity model, the balance of the investment account is affected by the net income share of the parent from the subsidiary, and likewise affected by the dividends paid, and also affected by any amortization of the allocated excess. So the investment account balance will increase or decrease, whereas in the cost model, the balance of the account will still be the same. That's the amount to be eliminated. Number 30, Pendleton Company acquired 70% interest in Sunflower Company on December 31, 20x4 for 380,000. During 20x5, Sunflower had a net income of 30,000 and paid a cash dividend of 10,000. Applying the cost model or method would give a debit balance in the investment in stock of Sunflower Company at the end of 20x5 of. So in number 30, we have again the balance of the investment account is 380,000. The fact that we still use the cost model. Next, in number 31, on May 1, X6 Pine Incorporated formed Sign Incorporated investing 500,000 cash. For 20x6, Sign reported net income of 65,000 and declared and paid cash dividends of 25,000. Under the cost method, what amount appears in the parent separate 20x6 income statement, not the consolidated income statement. So it's still the amount of 25,000. The question is, the parents separate 20x6 income statement. So, under the cost method, what amount appears in the parents' separate income statement? So, we have now the amount that was paid by Pine or by Sign as the amount of dividends. So the amount of dividends of 25,000 as declared by the subsidiary. So actually it's the amount of 25,000 representing cash dividends. So again we have letter A. Okay, I am going to share screen numbers 32 and 33, 35, 36, 37, and 38. Then I will discuss again 39 to 41. So this time we share screen number 32 up to number 38. So at least you have the solution. Okay, so that's number 38. Then we have numbers 39 up to 41, 39 to number 41. Now, the questions in number 39 up to, actually, it's 39 to 43, not 41. On May 1, 2024, Peter's company purchased 80% of the common stock of Smith Company for 50,000. Additional data concerning these two companies for years 20x4 and 20x5. We have now Peters and Smith. So Peter now is the acquiring and Smith is the acquired. Given are the data for 20x4 and 20x5. For the common stock, other contributed capital for Peters and Smith. Then we have retained earnings, net income or loss, and cash dividends. Any difference between the book value and the value implied by the purchase price relates to Smith Company's land. Peters Company uses the cost method to record its investment. Now calculate in number 39 the controlling interest in consolidated net income for 20x4. So we have now the solution to number 39. Here we have in number 39 the final answer is 86,400. Calculate the controlling interest in consolidated net income for 20x4. And we have now the reported net income of Peter in the amount of 64,000 in 20x4 and for 20x5, 37,500. Then we have to deduct dividend income from Smith. So Smith declared a dividend income equal to 2,000. So we multiply for Peter, we multiply 2,000 by 80% and for 20x4. So the dividend income from Smith is 2,000 multiplied by 80%. 20x5, there's no declaration. Then we add Peter's share of Smith's net income in 20x4 since acquisition. So we have now the net income in number 39. We are adding the 20x4 net income of Smith is given at 45,000. That's the net income of Smith in 20x4. So for the amount of 80% multiplied by 8 over 12 since the acquisition date was May 1. So we deduct 12 from 4 years, leaving us 8 months, no? At 12 months in 1 year minus 4 months from May 1. So that gives us 8 months. Okay, for the difference of 8 months. So we now have 80% of 8 over 12. That's good for 8 months from May 1. And we multiply by 45,000. That's the net income reported by Smith. So we now get 24,000 in 20x4 share of Peter in the net income of Smith. Then we deduct Peter's share of Smith's net loss in 20x4. So we have the net loss of Smith in 20x4. It's for the amount of here 5,000, and you multiply it by 80%. Now, any difference between the book value and the value implied by the purchase price relates to Smith Company's land. Peter's company uses the cost method to record its investment. Now take note that the net income of Smith for 20x4 is 45,000, whereas in 20x5 Smith is reporting a net loss in the amount of 5,000. So that's supposed to be less Peter's share of Smith's net loss in 20x5. So you multiply 80% by 5,000 or 4,000 negative. So the controlling interest in consolidated net income for 20x4 is 86,400 and 20x5 is 33,500. So number 39, the answer is C. Since question is referring only to the net income of 20x4. Then number 40, calculate the controlling interest in consolidated net income for 20x5. Calculate controlling interest in consolidated net income for 20x5. And that's now in number 40, the amount of 33,500. We still have the solution in number 40. Then we go to number 41. Calculate controlling interest in consolidated retained earnings for 20x4. So number 41, the answer is 151,400. Remember that we have the controlling interest in consolidated retained earnings. So we have now the share of Peter in the December 31 retained earnings. So we have now the retained earnings of 80,000. We are now referring to Peter, 80,000, and we add 64,000, but we deduct 15,000. So Peter company reported net income of 64,000 in the year. That was in 20x4. It reported net income of 64,000 and deducted 15,000 for here we have net income as given in the amount of 45,000. And we have now in 20x5. So 20x4, we are adding 80,000 plus 64,000. So that means 144,000 minus 15 is the difference of 129,000. Then we add Peter's share of the increase in Smith's retained earnings. So the retained earnings of Smith beginning is 10,000, and we have the 20x5 amount of 53,000. So we have now from the date of acquisition to the current price. Now we are given the amount of the retained earnings of Smith at the beginning of the period and at the end of the period. Now Peter's share, 80% of 53,000 minus 25,000, and for 20x5 we have 48,000 minus 25,000. So we have now the amounts of the retained earnings. So you look at retained earnings of Peter, it's 80,000, the initial amount, and then the ending balance of 129,000. That's for the ending balance of 20x4. Then in the 20x4, again, we have the share of Peter in the increase in the retained earnings of Smith. So the increase in the retained earnings of Smith now is 80% of 53 minus 25, and you multiply it by 80%, so you get 22 400. And for the next year, we have 48,000 minus 25, and then you multiply by 80%, so you get 18,400. That's in question number 40. Refer to number 39. Question number 41. We have the total of 151 400 for 20x4. And 42, calculate the controlling interest in consolidated retained earnings. So number 42, for 20x5, we have 179 900. That's the consolidated retained earnings for number 42. So we have now 179 900. Now we are asked about the consolidated retained earnings. So number 42, 39 up to number 42. Next, number 43, the following accounts as they appear. So the following accounts as they appear in on the separate company financial statements. So we have now the accounts as they appear on the separate company financial statements. So parent in its 100% owned subsidiary created in 20x1 at the end of 20x6. What amount should be reported for consolidated retained earnings at the end of 20x6. So the answer to number 43, retained earnings of parent, December 31, 20x6, by using the cost method, we have the amount of 360,000 and the decrease in the retained earnings of the subsidiary, since subsidiaries retained earnings this time is a deficit. So we have now the retained earnings of the parent in 12/31/20x6 using the equity method, and we have now the same with consolidated retained earnings. So we have now the amount of 320,000. Again, I'm going to share screen numbers 44 and 45. There you already have the answers to numbers 44 and numbers 45. And then we continue with numbers 46 up to 50. January 1, 2024, Plimsoll Company acquired 100% of Shipping Corporation's voting shares of underlying book value. Plimsoll uses the cost model in accounting for its investment in shipping. Shipping retained earnings was 75,000 on the date of acquisition. Now take note that the acquisition rate of Plimsoll is 100%, and the retained earnings of here of shipping is 75,000 on the date of acquisition. On December 31, 20x4, the trial balance data for the two companies are as follows. So we have now Plimsoll company, and then we have shipping corporation with the debits and the credits. So take note, this time both companies have current assets, depreciable assets. Then Plimsoll has investment in shipping stock. Both have depreciation expense and other expenses, dividends declared, current liabilities, long-term debts, common stock, retained earnings, sales, and dividend income. What amount of net income will be reported in the consolidated financial statements prepared on December 31, 20x4? So if we have now the question asking for net income to be reported in the consolidated financial statements. So we have now the net income from its own operations. We have now P company with net income initially. We have sales of 150,000. That's now P company. Sales of 150,000, and we are given the depreciation expense and the other expenses of P company. Take note that depreciation is 20,000, other expenses is 60,000. So there is a difference of 70,000. So that's for P company. 150 is the amount of sales, and we have 20,000 for the depreciation and other expenses of 60,000. So we now have 70,000. Then for S company, we have 100,000 minus the depreciation of 15 and other expenses of 45. So meaning 60, there is net income of S company of 40,000. Okay, now take note, P company, you have to delete 30,200 minus. So you have to delete 30,200 minus. So what will remain is only 150, no? Or 150,000 minus 20,000 and 60,000. So the total net income of the two companies of 110,000. The non-controlling interest in net income in number 46, ownership of the parent is 100%. So there is no non-controlling interest. You have no amortization of allocated excess since there's none and there's no goodwill impairment. So the difference is 110,000. We have now the controlling interest in consolidated net income or profit attributable to equity holders of parent. Then we add the non-controlling interest in net income. There's no non-controlling interest. So the consolidated net income for 20x4 is 110,000. So that is letter C for number 46. Then in number 47, what amount of total assets will be reported in the consolidated balance sheet prepared on December 31, 20x4? So what amount of total assets? Now we are referring to number 47, the total assets of Plinsol, current assets of 100,000 and depreciable assets of 200,000. So 300,000. Shipping has current assets of 75,000 and depreciable assets of 150,000, the total of 225,000. That's now the total of the assets of the two companies. So number 47 is 525,000. Then we go to number 48. Okay, we are now dealing with numbers 48 up to 50. So in number 48, the question is, what amount of retained earnings will be reported in the consolidated balance sheet prepared on December 31, 20x4? So what amount of retained earnings? Now, we have the retained earnings of the parent in the amount of 150,000. That's the parent's retained earnings. As you will notice here, we have a question or there's no amount. Your 150,000 is sales. So retained earnings of the parent is not given. We can compute retained earnings of Plinsol on January 1, 2024 using the cost method will be the same with the equity method and consolidated retained earnings since it's the date of acquisition. So here we have retained earnings given of above, no? Refer to it common stock, and then after common stock, you have retained earnings. So the amount is 150,000. Sales is also 150,000. So the amounts are the same. However, the retained earnings given is 150,000. Then we add controlling interest in consolidated net income. So we have now the consolidated net income in number 46. We have the amount of 110,000, and we deduct the dividends. Dividends declared by the subsidiary. So the dividends declared by the parent is 25,000. Dividends declared by the parent only. So we deduct 25,000. The retained earnings using the equity method is 235,000. That's letter A for number 48. Number 49, what is the total of liabilities that will be reported in the consolidated balance sheet prepared on December 31, 2024. So number 49, the amount of 190,000, consolidated balance sheet in number 49. That of Plimsoll is 40,000 and 75,000, and that of shipping is 25,000 and 50,000. So that makes a total of 75,000. Total liabilities of 190,000. In number 49, it's letter D. Then we have number 50. What amount of total stockholders' equity will be reported in the consolidated balance sheet prepared on December 31, 2024? So in number 50, we have the total assets. In number 47, less total liabilities. In number 49, in the amount of 190,000. So we are now referring to numbers here. Total assets in number 47 of 525,000, and total liabilities of 190,000. So we now get the amount of liabilities 190. Number 50, we have the net stockholders equity of 335,000. It's the letter here. What amount of total stockholders equity will be reported in the consolidated balance sheet prepared on December 31, 2024? So we have the total assets in number 47, and we have the total liabilities in number 49. So the difference is that stockholders equity of 335,000. Now make correction. The answer is letter B as in boy. B as in boy, we have the total stockholders equity. Next, we have numbers 51 to number 63. This so far a long problem. Okay, on January 1, parent company acquired 90% of subsidiary company in exchange for 5,400 shares of 10 peso per common stock, having a market value of 120,600. Parent and subsidiary consolidated balance sheet on January 1 were as follows. So we have now the accounts of the parent and the subsidiary, including their assets, liabilities, and stockholders' equity. At the date of acquisition, using partial goodwill approach, all assets and liabilities of subsidiary company have book value approximately equal to their respective market values except the following as determined by appraisal as follows. So we have now the inventories using the FIFO method, and then the equipment with remaining life of 4 years, and we have the patent with remaining life of 10 years. So we have now 17,100 for inventories, equipment 48,000, and patents for 13,000. The amount of goodwill on January 1 is, so in number 51, the fair value of subsidiary is computed as consideration transferred is given at 5,400 shares. So that is given at 120,600. Then we deduct the book value of stockholders' equity on January 1, a common stock of subsidiaries 50,000 multiplied by 90% or 45,000. Then the APIC is 15,000 and the retained earnings of 41,000. So we have now the net amount of 95,400. The allocated excess of 25,200. The allocated excess. Then we have the over or the undervaluation of assets and liabilities. The inventory initially, the inventory's value in the book of the subsidiary is 16,100, and it's now with a fair value of 17,100. So there's a difference of 1,000 multiplied by the acquisition rate of 90%. Then we have the increase in equipment of 48,000 here minus 40,000. So it's 8,000 multiplied by 90%. In the patents of 13,000 minus 10,000 for the patents given. So there's a difference of 3,000 multiplied by 90%. So you get 2,700. 25,200 minus 10,800. So we have now the positive excess as goodwill for 14,400. Now number 51 is asking for the amount of the goodwill on January 1. So it's 14,400. The non-controlling interest on January 1 is here we have number 52, the common stock of 50,000 APIC, 15,000 retained earnings of 41,000, total 106,000, and we have the adjustments to reflect a fair value of 12,000 So we have 12,000, adding 1,000 for inventory, 8,000 for equipment. So that makes 9,000, and for patents it's 3,000. So all in all, we have adjustments to reflect fair value for 12,000. Whereas the stockholders' equity of the subsidiary is 106,000. Now we have the fair value of the stockholders' equity on January 1 equal to 118,000, and we multiply by the non-controlling rate of 10%. So we have 11,800. It's letter C for number 52. Number 53, the equity holders of parent or controlling interest retained earnings on January 1. So how much is the retained earnings on January 1? It's only that of the parent. So the amount is letter A for 48,000. Actually, that's given amount of retained earnings in the parent's column. The consolidated retained earnings on January 1. So we now have number 54. The consolidated retained earnings January 1 is still 48,000. 54 is letter A. On the date of acquisition, the parent's retained earnings is also the consolidated retained earnings. That's on the date of acquisition. So letter B is in number 54, letter A is the answer. Next, number 55. For the year end, December 31, the following results were given. Dividends paid by the parent of 15,000, and dividends paid by subsidiaries 4,000, and we have the amounts of net income. The investment balance using the cost model on December 31 is still the initial value of 120,600. Now, under the cost model, the investment account is not affected by whatever net income share of the parent from the subsidiary or whatever dividends declared by the subsidiary. So in number 55, the answer is still letter B. Next, number 56, using the same information in number 55, compute the dividend income for the year. So the amount of dividend income uh, for the parent. So in number 456, we have now 4,000. That's the dividend paid by the subsidiary, and 90% of it belongs to the parent. So in number 56, it's 3,600. Number 7, using the same information in number 55, the non-controlling interest in net income on December 31. So we have now the non-controlling interest in net income. So number 57, the consolidated net income for 20x4 P company is 4,000 times 90%. Now, the consolidated net income of here we have 30,200. That's the net income of the parent as given. And the net income of the subsidiary is given at 9,400. But we are now using the cost model. So the net income of the parent of 30,200, and we deduct 4,000 times 90%. That's the dividends paid by the subsidiary. So if you have to eliminate the share of the parent, the difference is 26,600. Then we add the net income of S company in the amount of 9,400. Okay? So we now get total of 36,000. Then we deduct the non-controlling interest in net income in the amount of 610 as computed below. Net income of subsidiary 9,400. The allocation of the allocated excess is amortized at 3,300. So we have 6,100. We multiply by the non-controlling interest 610. That's now your non-controlling interest in net income. So we have now the amortization of the allocated excess in the amount of 3,300. So we have the non-controlling interest in net income of 610, and then we have the amortization of the allocated excess, that of the parent, and we have the goodwill impairment as 0. So 3,910. The controlling interest in consolidated net income or profit attributable to equity holders of parent. So we now get 2,090. Okay, if we have to deduct 3,910, and we add back the non-controlling interest in consolidated net income of 610, consolidated net income for 20x4 of 32,700. Now number 7, the non-controlling interest in net income on December 31, then the answer is C, that's 610 is computed. Then number 58, using the same information in number 55, the non-controlling interest on December 31 is computed as the non-controlling interest in net assets. Here we have the amount of common stock of 50,000. The common stock of 50,000. Li, 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 li. Patay. Stop recording. Screen sharing is post. Gamay. Gamay mo. Okay, now we go to number 58. The non-controlling interest in net assets. We have now the common stock of the subsidiary is given at 50,000. The additional paid-in capital of 15,000. Then the retained earnings of 41,000. We are adding net income for 9,400 in deduct dividends. So that makes 46,400, the book value of 111,400. We add adjustments to reflect fair value above of 12,000 and amortization of the allocated excess of 3,300. So we have now the fair value of the net assets of 120,100, and we multiply by the non-controlling interest of 10%. We have now the non-controlling interest in net assets. So in number 58, the answer is letter C, 12,010. Then number 59, using the same information in number 55, the profit attributable to equity holders of parent or controlling interest in consolidated net income in number 59. The answer is 32,090. Again, we refer to the number 57 for computations. So we have now the answer to number 59 is letter B. Here we have 32,090. Then number 60, again, the consolidated group net income on December 31 is 32,700 for number 60. Then we have number 61, using the same information in number 55, the consolidated retained earnings on December 31 is. So number 62 is still 65,090. Now the answer is the same with that of number 61. Then number 63, consolidated total equity is to be computed. So we have now the amount of 312,700, adding controlling interest, equity holders attributable to parent. We have now the common stock of 100,000, and we add the given investment rate of 120,600. Then we have the peak of P, given is 50,000. Then minus or add 120,600 minus 54,000. And we have now the retained earnings of P. We refer back to numbers 61 and 62. The parent stockholders' equity or controlling interest given of 300,690, and we have to add the non-controlling interest. So the consolidated equity of letter C. Now we have the use of the equity method in number 64 and number 65. So let's take up these two numbers in connection with the equity method. So we now begin with number 64. Prime Industries acquired an 80% interest in Sun's company by purchasing 24,000 of its 30,000 outstanding shares of common stock, book value of 105,000 on January 1, 2024. Sun's reported net income of 45,000 in 2024 and 60,000 in 20x5, earned evenly throughout the respective years. Prime received 12,000 dividends from Sons in 20x4 and 18,000 in 20x5. Prime uses the equity method to record the investment. Prime should record investment from Sons during 20x5 in the amount of, so we have now 60,000 multiplied by 80% in the investment rate. So you multiply it by 60,000 times 80%. We are now given the investment rate at 80% of the by purchasing 24,000 of the outstanding shares with book value 105,000, and the reported net income are given throughout the year and the equity method is used. So the investment income from Sons is equal to 80% multiplied by the 60,000 net income of Sons. Then number 65, the balance of Prime's investment in Sons account on December 31, 20x5 is equal to, we have now investment at the beginning of the period 105,000, then we have to add the share in net income in 20x4 45,000 times 80%, and we have to deduct the dividends received, the amount of dividends paid by Sons, 12,000, and we have now the total because Prime received. In other words, this 12,000 and 18,000 are already the shares of Prime, not the total dividends paid by Sons, but the total amounts received by Prime. So that's why the dividends of 12,000, we are not multiplying it by 80% anymore because as stated, this amount was really received by Prime. So we have now the investment. Take note that for investment 105,000 we debit, and then we have another debit for investment income, and we credit the investment account for the dividends received. So investment, debit investment in Prime for the share in net income. Then we have to debit investment in Prime, credit investment income. For the dividends received, we now debit to here cash and credit to investment in Sons. Why it's a deduction. Then we add share in net income for 20x5 and deduct dividends. So the balance of the investment account on December 31, 20x5 is 159,000. Now, as we know that under the equity method, the investment account balance is affected by the share of the parent in the net income and as well as the dividends received. Now, you take 66, share screen ko lang, and number 67, 68, then 69, okay, 69 to 71. Now, take note that these problems I'm already sharing. Now we go to number 75 to 85. So meaning I'll share screen up to number 74. Number 75, we have in number 75 to 85. Following are selected accounts for Green Corporation and Vega Company as of December 31, 2024. Several of Green's accounts have been omitted. So we have now Green and Vega, the balances of revenues, cost of goods sold, depreciation expense, other expenses, and investment income is question mark. Then we have retained earnings, dividends, current assets, land, buildings, equipment, liabilities, common stock, and additional paid-in capital. Green obtained 100% of Vega on January 1, 20x0 by issuing 10,500 shares of its 10 peso par value common stock with a fair value of 95 per share. On January 1, 20x0, Vega's land was undervalued by 40,000. Its buildings were overvalued by 30,000 and equipment was undervalued by 80,000. The buildings have a 20-year life and the equipment is 10-year life. 50,000 was attributed to an unrecorded trademark with a 60-year remaining life. There was no goodwill associated with this investment. Assume the use of the equity method. Now in number 75, compute for the book value of Vega January 1, 20x0. So the book value of Vega in number 75. Okay, we now compute for the book value of Vega. We have now the consideration transferred of 10,500 shares at 95. And now we deduct the book value of the stockholders' equity. So initially, we have to consider the overvaluation or the undervaluation of the assets and the liabilities. Land is undervalued by 40,000. Building is overvalued by 30,000 and equipment is undervalued by 80,000 and we have the unrecorded trademark for 50,000. So the net over undervaluation of assets and liabilities is 140,000. So we have 40 minus 30 plus 80 plus 50. We now have 140. And finally, 997,500 minus 140,000. So we determine the book value of the stockholders' equity of here, Vega, of 807,500. So that's now letter B as in boy. Next, in number 76, compute the December 31, 20x4 consolidated revenues. So in number 76, we have 900,000 for the consolidated revenues, 900,000 and 500,000. We have the consolidated revenue of 1,400,000. So number 76 is letter A, 1,400,000. Then we go to number 77. Compute the December 31, 20x4 consolidated total expenses. So we now have in number 77, assume the total expenses includes cost of goods sold, which is different when the question is total operating expenses. So the cost of goods sold is to be compute is given at 360,000 plus 200,000. Then we have the depreciation of 140 and 40, total 180,000. Others, then we have other expenses of 100,000 and 60,000, 160,000. Then we have the allocation of the amortization, of the allocated excess for buildings 30,000 divided by remaining life of 20. So it's negative 1.5 because as stated here, the building is overvalued by 30,000. That's why its amortization or depreciation is deduction because it was overvalued. The equipment is undervalued by 80,000, so we have to add, and the trademark is undervalued by 50,000 in the remaining life of 16 years. So we now get the total expenses of 909,625 in number 77. Then number 78, compute the December 31, 2024 consolidated buildings. So we have now the buildings net and 750 and 280. That means a total of 1,030,000. And the building, as stated, is undervalued. So the buildings have a 20-year life. The equipment is 10-year life. And we have now the amounts for the building overvalued by 30,000. So the amount in number 78 for the buildings is 1,007,500, and that includes your amortization or depreciation on the building. 750,000 the building of the parent, 280,000 that of the subsidiary. Then we deduct the overvaluation of 30,000 and 30,000 divided by the remaining life of the building. That's equal to 20. So we now get 1,500 times 5 years. So you get 1,007,500. Then number 79, compute the December 31, 2024 consolidated equipment. So we have now your equipment of 300,000 and 500,000, and we have the undervaluation of 80,000. So that makes 880,000. But 8,000 is taken by dividing 80,000 by 10 years. So it's stated that the equipment is 10-year life and that the equipment was undervalued by 80,000. So we have now the added amount of depreciation for the equipment of 8,000 per year multiplied by 5 years. So that makes 40,000. 880,000 minus 40,000 or 840,000. Then in number 80, compute the December 31, 2024 consolidated land. So we have now the land accounts 450 plus 180 for number 80. So we have 450 and 180, and it's stated that the land is undervalued for 40,000. So we are adding in number 80. So total is 670,000. That's letter C. Then for number 81, compute the consolidated trademark. Here, trademark for the total. That's now number 81. So number 81, the trademark is here. The question is asking for the consolidated trademark. So we have the trademark in the amount of 50,000 given, and with a remaining life of 16 years. So 50,000 divided by 16 years. So we have the annual amortization equal to 3,125. Then you multiply it by a period of 5 years from x0 to x4. So we now get 34, 375 for number 81. It's letter 34, 375. So it's letter D for number 81. Then number 82, the amount of the consolidated common stock. Now we are given the common stock of the parent equal to 450,000. So parent only. Number 83 for the consolidated peak is 75. So meaning it's parent only. Then number 84, consolidated retained earnings in number 84. So that gives us the consolidated retained earnings on January 1 using the equity method. So consolidated retained earnings in the amount of parent only 1,350,000. Then we add the controlling interest in consolidated net income or profit attributable to equity holders of parent for 490,375. 490,375. Okay, so we have the figure of 490,375 computed below. A non-controlling interest for Goodwill, we have P company and 300,000 for P company, 300,000, and we have for S company for 200,000. So the total of here 500,000. The non-controlling interest under the full goodwill approach. So P company is given at 300,000 and 200,000 for S company. The total, and we deduct the non-controlling interest in net income is 0. Then we have the amortization of the allocated excess as computed above, and the goodwill impairment is 0. So the controlling interest in consolidated net income or profit applicable attributable to equity holders of parent is 490,375. So that's now 493,775 in number 84. We are asked for the consolidated retained earnings. So we have 1,645,375. Then the last number is number 85. Compute the equity index income reported by Green for 20x4. So we have the answer of 193,375, share in net income of 200,000 times 100% and the amortization of allocated excess. Now I'll stop here, but anyway, I'll share screen the rest of the solutions. We are still up to 188 and the theory. So I'll just share screen all. You might be interested in these solutions. Okay, so we have 91, 92, Okay, that ends the giving of solutions. Now the test on Thursday will be good for three 3 hours. Yan, eh. Ano ba? Ang balak kayo. Okay na to. Ha? Hindi mo tayo. Sige lang, hindi na. Okay. The test on Thursday will be good for 3 hours. So actually, we will begin not at 7 because at 7 I will have the arrangements considering that we will be on open cam. So just come at 7, but the test will be good only for 125 items. So that will be 1 to 30 for true or false, 1 to 30 for multiple choice theory, and 1 to 30 only for the multiple choice problem. So the test will be good only for 120 items. So I'll see to it that the problem, since you have 30 problems, will be given a longer time. So the problems will be given 30 items times 5 minutes. So that will be 150 minutes. We divide it by 60. That will be 2.5 hours. 2.5 hours. Now for the theory, the multiple choice theory will be given 1 minute each. So that will be good for 30 questions times 1 minute. So that will be 30 minutes or 1/2 hour. Then for the true or false, I will be giving it anyway 1 minute each. So that will be good also for 1/2 hour. So all in all, we have a total of 3.5 hours. So anyway, I'll revise my previous statement. We will actually begin at 7. You must be around so I can already announce on the arrangements, how the open cam will be used, the gadgets, and all this. But the test will actually begin at 7:30. So we will actually begin at 7:30. Now considering that we have a total of 3.5 hours left, so the test will be good for 3.5 hours since we have a total of 4 hours. So we will begin at 7:30 after the fixing of the arrangements and all this. Okay? So this time you are given longer time. Thank you and God bless you. Naman, ni Kwan siya, convert. Wala yan.
Ayun na, ayun na.